The US economy is absolutely booming right now in the fall of 2021. At least that's what Joe Biden and Jerome Powell, along with the mainstream media, want you to believe. They want you to look at the 4.8% unemployment rate that was just revealed in September. They want you to look at the 12 million job openings and think that the US economy is really healthy and that we're in an economic boom like we have never seen before. However, folks, that is unfortunately not the case. When you look at the underlying data, which is something that we're going to do in this video, you realize that the US economy is built on a house of cards right now. A house of cards built by the combination of federal government spending and multiple raging asset bubbles, which are combining to mask the fact that our economy is really struggling and that another recession could be around the corner in just the next 6 months. That's what I'm going to do in this video for all of you who want to learn more about where the US economy is heading, where the stock market and housing market are going. I'm going to give you the underlying data that no one else is talking about. And let me tell you guys, this data is not painting a pretty picture. Let's get into it. And the number one metric where things do not look very good is in terms of jobs, which is what we're looking at on this graph. We're looking at job growth in the US over the last 7 decades, all the way back to the early 1950s. And specifically, we're looking at how much jobs have declined in recent months and recent years compared to historical norms. So if you go to September 2021, you can see that today, the US has 147.6 million jobs, according to the Bureau of Labor Statistics. 2 years ago, just 24 months ago, that job count was 151 million. So today, the job levels in America are 3.8 million below where they were 2 years ago. You can see that represented by this dotted yellow line and see very clearly that a 3.8 million decline in jobs over 2 years is historically unprecedented. Outside of the Great Recession and financial crash from 2008 to 2011, there was no other period in US history where jobs have declined by this much. And what's really concerning is that we are now well over a year into this pandemic recovery, and we are still over a year into this recovery at minus 3.8 million jobs, a level which on its own is one of the highest of all time. That stands in stark contrast to the perception being perpetrated by Joe Biden, Jerome Powell, the mainstream media, who are acting like because of our 4.8% unemployment rate today that things are hunky-dory. But folks, the reason that the unemployment rate is so low is because so many people are dropping out of the labor force and not looking for work. What really matters are the raw job counts, which I just showed you on the previous graph. And what's evident from that is that we're still actually in a big recession here in the fall of 2021. And how is it that in this economy, which is down 4 million jobs and has this kind of phony and fake 4.8% unemployment rate, how is it that the perception is that things are good? And how is it that consumers are spending money and that businesses are expanding when the job numbers are so bad? Well, I'm going to show you guys on this next graph. And that's because despite the big job losses that we've seen in America over the last 2 years, the income levels of Americans has actually gone up during the pandemic, which you can see on this graph, which tracks the total aggregate personal income of all Americans. This is data that comes from the Bureau of Economic Analysis. We can see here back in January 2018, income was 17 trillion. In January 2019, it was 18 trillion. And right before the pandemic, it was 19 trillion in February 2020. And then look what happened. The pandemic occurred and all of a sudden, whoa, income actually shot up. In April 2020, Americans were making more. In April 2020, the worst month for U.S. employment ever, Americans were actually making more than they were before. And by and large, these higher income levels have sustained themselves as the pandemic has gone on, to the point now, August 2021, the most recent data available, we can see 20.7 trillion income in the U.S. compared to 19 trillion prior to the pandemic. And so Americans are making way more money than they used to, and that's why the underlying economy seems like it's strong, because the personal incomes of Americans are going up. They have more money to spend on goods and services, and businesses are liking that, so they're expanding production and putting all these hiring signs up, and we have 12 million job openings, and things seem so great because these income levels are really high. But I think many of you are now probably scratching your head and asking a question here, wait a minute, how is it possible that the personal income of Americans went up so much when the job count went down by so much? Like, that doesn't make sense, right? And no, guys, it actually doesn't make any sense unless you start thinking about what the US government did over the last 18 months. When you start thinking about the 3 different stimulus checks that the government sent out directly into the bank accounts of Americans. Or when you think about the fact that unemployment insurance was extended basically perpetually. Normally, you can only be on unemployment for about 6 months, but during the pandemic, you were allowed to be on unemployment forever. Or when you think about the fact that you weren't allowed to be evicted or foreclosed on, which basically gave people an incentive not to pay their rent, but then to spend the money into the economy instead. It's this short-term government intervention which increased the income of Americans. Now we're back to this graph, and you can see what it looks like if we back out those government transfer payments, which is what the blue line does. It takes personal income and then backs out the government transfer payments, i.e. the stimulus checks, the extended unemployment assistance, and oh boy, you can see now we all of a sudden have a very different picture. Instead of having these big spikes in income over the last 15 to 18 months, we actually see a big decline in income for most of 2020, all the way to the point that here in August 2021, we see 16.5 trillion in income, which is a much smaller increase over the pre-pandemic levels than we see on the total income level that includes government stimulus payments. Things look even worse when we adjust for inflation, which is what the orange line does. It takes personal income minus government transfer payments and adjusts it downward for the levels of inflation. And with that, we can actually see in August 2021 that Americans are making less money than they were prior to the pandemic in February 2020. And so this is the story here. This is the story to remember, guys, is that the perception of a booming economy with a lot of people spending money and businesses expanding and wanting to add more people, add more employment, this is all based on government intervention. It's all based on the government sending checks to Americans, whether they be through stimulus checks or unemployment assistance, and basically then having that money get spent into the local economy. And that when you back out the government transfers, and then when you adjust for inflation, you see that Americans today are actually poorer than they were 18 months ago prior to the pandemic. And this stands in stark contrast to what we're seeing in various asset markets like the stock market, like the housing market, and cryptocurrency, at the same time that Americans are doing worse than they were 18 months ago in terms of their income adjusted for government spending and inflation. All of these asset prices and asset markets are exploding and going nuts. And you can see that exemplified on this graph, which is looking at the increase in the stock market, the S&P 500, over the last 2 years, which is the yellow line. You can see a 55% increase in the level of the S&P 500 index. And it's comparing that to the 24% increase we've seen in home prices, according to the increase in the Zillow Home Price Index. So we have 2 big asset bubbles going on right now, where both the stock market and the housing market are doing really well. They're suggesting that underlying fundamentals are good, and that businesses are doing well, and that people are doing well. And as a result, the value of stocks, the value of companies, the value of housing is going up in America. And these asset bubbles are also perpetuating a false perception that things are good. Because for instance, because the housing market is up by 24% over the last 2 years, that means that over 150,000 new realtors have piled into the workforce. That's right, 150,000 increase in realtors over the last 2 years, all due to surging home prices. Meanwhile, because the stock market's really frothy, you have all of these companies, often who make no money, that are doing initial public offerings and going public, taking money from investors, and then employing more people because of that. So now these asset bubbles are actually having a real impact on the economy and producing employment. The question to ask is, what happens to a lot of the employment related to the housing market and the stock market when the asset bubbles inevitably pop? Which they will. They will pop. The stock market being up by 55% and the housing market being up by 24% over 2 years does not make any sense when the regular American is no better than they were 2 years ago. And this disconnect is evidenced if we go back to this graph, where again, we have the S&P 500, we have the housing market, now we have this gray line, which is that increase in real personal income minus government transfer payments. You can see that the typical American income adjusted for inflation and government transfer payments is really no higher than it was 2 years ago, yet we have the housing market and the stock market way higher. In addition, we can add jobs to this graph as well. The job count today is 2.5% lower than it was 2 years ago, yet we have the housing market 24% higher, the stock market 55% higher. And this disconnect between asset prices and the real economy, aka where jobs and income are at, this was allowed to exist primarily because of low interest rates. We were in a record low interest rate environment for most of the last 18 months during the pandemic. We had the Federal Reserve QE, quantitative easing. We had all of that stuff supporting asset prices even when the underlying economy wasn't very strong. However, all of that's going into reverse now. The Federal Reserve just announced that they're going to start tapering their quantitative easing, aka buying treasury bills and mortgage-backed securities. They're going to start tapering that in November. At the same time, we're seeing a massive spike in long-term interest rates. The yield on the US 10-year treasury has gone up by 50 basis points in the last couple months. So all of the accommodative monetary policy that was allowing these asset bubbles to exist is heading into reverse, just as all of the accommodative fiscal policy from the US government is also heading into reverse. And this, in my opinion, means that we're going to have big problems in both the real economy in America over the next 6 months, as well as all of the asset markets in America, whether it be the stock market, the housing market, the crypto market. I think we're going to see big pain pretty much everywhere over the next 6 months now that the training wheels of government and Federal Reserve intervention are coming off. And they're coming off in a scenario when income and jobs haven't recovered yet. Remember, we're still down 3.8 million in jobs from where we were 2 years ago. Those people are no longer going to be receiving stimulus checks or extended unemployment insurance. Maybe some of them do find a job as a result. However, I think many won't, because I think many of these job losses are permanent. A lot of businesses shut down for good over the last 2 years. At the same time, as the asset bubbles erode and pop, a lot of the employment related to those asset bubbles is going to go away, is going to go down. And this really could become a self-fulfilling prophecy and end up in a massive, massive crash. And so the question that you guys need to ask yourself is this: now that extended unemployment assistance is gone as of September 4th, now that there's no more stimulus checks, now that the eviction foreclosure moratoriums are gone, now that the Fed has indicated that they're going to taper QE, now that long-term interest rates are going up, with all of these headwinds, do you feel like the underlying economy is strong enough to keep growing? I know what I think the result is going to be from all of this, but really you need to ask yourself what you think. And I want to actually hear it in the comments. What do you guys think the future is for the U.S. economy based off all of this, for the U.S. stock market, for the housing market? Where are things going over the next 6 months? I want to hear what you think down below. If you guys enjoyed this video, if you enjoyed this content, just make sure you've hit the like button if you haven't done that already. When you hit the like button, it gives me some support here on YouTube, gets this video out there to more people, and as a result, I can then produce more of these videos going forward. Additionally, if you do want to see those videos, if you want to see the future content, make sure you're a subscriber. I come out with 3 videos per week covering the U.S. housing market, the U.S. economy. Now that the housing market and the economy is beginning to turn, you're going to want to track this going forward. Make sure you're a subscriber. Also think about joining the channel as a sponsor member. The cost is $5 a month. You get some really cool perks, most notably a monthly newsletter, which is exclusive to channel members, where I give you guys all of the data on the U.S. housing market. The most recent newsletter just came out 2 days ago. You can see a preview here on the screen. If you want to see what it's all about, get into it further, make sure to hit that join button below. All right, everyone, until next time, this is Nick from eVenture Consulting signing off.